The stock market did something strange again today. However, most people are looking at headlines, breaking news, and social media tips saying, buy this stock. In other words, things that are not really relevant. Meanwhile, what truly matters is happening in a much quieter place. Think about the year 2006. The American housing market was breaking record after record. Everyone was buying houses. Everyone was happy. Banks were handing out loans. Experts on television were saying housing prices in America never go down. But during the same period, a small group of people was doing the exact opposite. They were quietly taking positions. No one was listening to them. Some were even treated like fools. We all know what happened 2 years later. This is exactly what I want to talk to you about today. Smart money is moving right now, and most people do not even notice it. This video is here to help you understand that movement. In this video, we will not talk about financial advice or predictions. We will simply explain what the data, history, and the behavior of major players are telling us, in a clear and simple way. First, let's define the term smart money. Because when I say smart money, I am not talking about social media accounts that sell investment tips on Instagram. Smart money simply means institutional investors. It means hedge funds. It means people like Warren Buffett. It means Ray Dalio. It means the multi-billion-dollar portfolios they manage. What makes these people different from you? No one sends them an email saying, this crisis will start on March 14th. But these people see patterns, and those patterns usually form very slowly. Throughout history, before major financial events, very specific patterns appeared in the behavior of these players. Their cash positions started to increase. Interest in defensive assets increased. They moved away from complex financial products. They turned toward simple, tangible assets. And right now, some of these same patterns are appearing again. I am not exaggerating. Everything I am saying has a source. Statements from regulatory institutions, central bank data, public portfolio disclosures. Let's look at them together now. Let's talk about the most successful investor in history, Warren Buffett. Berkshire Hathaway currently holds the largest cash reserve in its history. The reserve is around $150 billion. It is the highest level both in nominal terms and as a percentage of assets. This is a man who has invested for decades with the philosophy that holding cash is foolish. There is a saying in the investment world, cash is trash. Buffett's general approach has always been in that direction. But right now, $150 billion is sitting on the sidelines. He aggressively reduced his Apple position starting in early 2024. In 6 months, he sold more than 600 million shares. Apple's weight in the portfolio dropped from 50% to 25%. Apple is the strongest brand in the world. Billions of users. Amazing cash flow. The company Buffett called the best investment of my life for many years. There are several possible explanations. It could be tax planning, valuation concerns, or tariff risks. But the result is the same. He is selling and not spending the money. He is keeping it on the side. This is a sign that he is waiting for something. He does not say exactly what he is waiting for, but he is preparing. Buffett has not lived through every major market cycle since 1929, of course. But during his career, he has seen the 1987 crash, the dot-com bubble, and the 2008 financial crisis. And every time he said the same thing, be cautious when others are greedy and be greedy when others are fearful. Buffett is cautious right now. Now I want to talk about something that most people never discuss. Index investing. In other words, investing money into the S&P 500 or a similar index. Over the last decade, this strategy has almost become a guaranteed way to make money. The philosophy is simple. Buy, hold, buy an index fund, and forget about it. Historically, this has been a very smart strategy, but the S&P 500 is currently at its highest level of concentration since the 1990s. The top 10 stocks make up around 40% of the entire index, and most of those 10 stocks are technology companies. You tell yourself, I am investing in 500 companies, so I have a very diversified portfolio. But in reality, almost half of your wealth depends on 10 names. Is that really diversified? Let's look at history. In 1972, there was a group of stocks called the Nifty 50. They were America's biggest and safest companies. Coca-Cola, Disney, McDonald's, Polaroid, Xerox. They were all described as stocks that could be held forever. The smartest people on Wall Street were buying them at an average price-to-earnings ratio of 42. Some reached 80 times earnings. Then came 1973. Inflation rose. Interest rates increased. A recession began. Disney fell 87%, Polaroid nearly 90%, Avon 86%, Xerox 71%. These were not speculative companies. These were some of America's strongest brands. Great companies were bought at the wrong prices. Now tell me this, where are the price-to-earnings ratios of today's technology giants? Some are above 30, 35, or even 40. The past guarantees nothing. But the pattern looks familiar. Now let's do a little math. Don't worry, it is not complicated. Global debt is currently around $300 trillion. When I say that as a number, it is hard to understand what it really means. Let me explain. The total annual output of the global economy, in other words, world GDP, is around $100 trillion. That means the world owes 3 times what it produces in a year. By itself, this is not a doomsday scenario. Debt has always existed. But we need to understand something. Most of this debt was accumulated during the lowest interest rate environment in history. For the last 15 years, central banks kept interest rates close to zero. Money was almost free. Governments, companies, and individuals all borrowed using cheap credit. Now interest rates have risen and are still rising. Debt mathematics works like this. As long as growth stays above the interest burden, debt remains manageable. But once the cost of interest becomes greater than growth, the picture changes. You have to take on new debt to manage existing debt. When you take on new debt, the interest burden grows. As the burden grows, even more debt is needed. At some point, this cycle breaks. Throughout history, countries and institutions have escaped this cycle in 3 ways: default, inflating the debt away, or severe economic contraction. All 3 create serious pressure on traditional investment portfolios. Smart money knows this. That is why it is moving. Over the last 3 years, central banks have bought gold at the highest rate in history. This is very important because central banks usually keep their reserves in dollars. They keep them in U.S. Treasury bonds. That has been the system for decades. But now, mainly China, Russia, India, and many emerging market central banks are reducing their dollar assets and buying physical gold. Think about it this way. Central banks are the largest institutions in a country, with the best information and the longest-term perspective. They are not chasing short-term profits. They are thinking about what will remain when a system breaks down. And they are buying gold while the system still looks strong. They are paying an insurance premium. This is not a panic move. It is a positioning move. And it is not only central banks. Large hedge funds are showing a similar trend. Farmland, water rights, energy infrastructure. Tangible assets that have value outside the financial system. Ray Dalio, the founder of Bridgewater, the world's largest hedge fund, has been warning about this for years. Debt cycles. The fragility of the monetary system. The importance of real assets such as gold. Dalio could be wrong. Everyone making this analysis could be wrong, but the cost of being wrong for these people is very high, and they are still taking these positions. Now let's move into a more technical area. But what I am about to explain is actually very simple. In public companies, stock transactions made by executives, CEOs, and major shareholders must be disclosed to the public. This is called an insider trading disclosure. These are legal disclosures made within the regulatory framework. Recently, these disclosures have shown an interesting pattern. Executives are making very positive public statements about their companies. Things like record quarter, strong growth, and optimistic outlook. But those same executives are selling shares of their own companies. And these sales are increasing across multiple sectors at the same time. If someone inside the company tells you everything is great while moving their own money out the door, what would you think? These may be planned sales made during specific windows. It could be tax planning. It could be diversification. But the overall picture says this: the people with the best information are reducing their positions. And this is often a pattern seen before major corrections. Now I am going to read you a list. Please listen carefully. Railroads once made up 63% of the U.S. stock market. People said, "You cannot go wrong investing in railroads." It was a technological revolution. Then it crashed. Everyone was making money in the stock market. Taxi drivers were giving stock tips. Everyone was going to become rich. Then came an 85% decline. Nifty 50. I mentioned it earlier. The safest companies. 87% losses. .com. The internet was real. The transformation was real. But the prices were not. NASDAQ fell 78%. It took 15 years to recover. Housing. Prices never go down. A small group of people like John Paulson saw it 2 years earlier. By the time everyone else saw it, it was too late. Every time the same thing happened. The technology was real. The companies were real. The growth was real. But the prices were wrong. And in the end, prices always won. Historically, the 10 largest stocks in the market represented around 20% of the total market value. This was the case from the 1990s until 2015. Today, that figure is around 40%. Exactly twice as much. Let's say you own an S&P 500 index fund. You tell yourself, "I invested in 500 companies, so I have diversified my risk." Mathematically, that is true. But in reality, almost half of your portfolio is concentrated in 10 companies. And most of those companies are technology firms whose valuations are driven by the artificial intelligence story. That does not make them bad companies, but it does not make them cheap either. And history tells us this: even great companies can disappoint investors for a very long time when they are bought at the wrong price. Now let me give you the good news. Everything I have talked about is not a disaster scenario. It is a map of opportunity. Think about it. What happened to the people who bought stocks in 2002 after the dot-com bubble when fear was at its peak? Over the next 15 years, they achieved extraordinary returns because they bought quality assets at panic prices. Who were the institutions that entered the market at the bottom of 2008 while everyone else was running away? Today, many of them are among the wealthiest investors in the world. Big players do not buy during periods of hype. They buy during periods of panic. So what do they do during hype periods? They build cash reserves. They reduce positions. They accumulate financial firepower for the day it will be needed. This strategy does not mean sell everything and leave. It means prepare. Now I need to stop here for a moment, because this part of the discussion does not answer the question, what should I do? The Money Archive is simply showing the bigger picture in this video, but if you want analysis related to your specific situation, write in the comments. Which topics would you like me to explore in more detail? Which asset class should we discuss? Which period should we examine? Now we come to a sensitive topic: artificial intelligence. We need to be very careful here because AI is real. The transformation is real. The impact this technology will have on the economy and business world over the next decade will be extraordinary. I say this because I truly believe it. But I also need to say this: the internet was real too, in 1999. And the people who said this time is different were right about one thing: the internet really did change everything. Now look at the valuations of today's AI companies. Some of them are worth hundreds of billions of dollars without yet generating significant revenue. If real technology is bought at the wrong price, it can create losses for a long time. This does not mean these technology companies will fail, but it may mean that today's price already includes growth that is expected far into the future. And that growth may not arrive on time, or it may happen in ways that investors do not expect. There is a short but important mechanism here. Stock valuations are based on the present value of future earnings. When interest rates are low, future earnings are discounted at a much higher value in today's terms. This pushes stock valuations higher. When interest rates rise, the present value of future earnings falls. This creates serious pressure, especially for high valuation growth companies. For the last 15 years, we have operated in an environment of near zero interest rates. Valuations were built around that reality. Now interest rates are high and may remain high. In this environment, stocks priced for high future growth are in the most vulnerable position. So how can you, as an individual investor, follow the moves of these major players? There are several practical ways. 13F filings. In the United States, institutions managing more than $100 million must report their portfolios to the SEC every quarter. This information is public. You can see what Buffett bought and sold. You can see what Dalio is holding. Central bank reports, especially changes in gold reserves and dollar reserves. These reports are published regularly. There is an indicator called skew. It shows how much protection the market is buying against a decline. When this indicator remains high for a long period, it suggests that institutions are becoming more defensive. Insider selling data. Executive buying and selling activity reported to the SEC. A simultaneous increase in selling across multiple sectors is a notable signal. Credit spreads. The difference between corporate bond yields and government bond yields. When this gap starts to widen, it means the market is becoming less willing to take risks. None of these indicators makes a decision on its own. But when they are evaluated together, a clearer picture begins to emerge. Let me tell you a truth. The biggest advantage of smart money is not analysis. It is patience. The ability to tolerate looking wrong. When Paulson said, "The housing market is collapsing," in 2006, people laughed at him for 2 years. His portfolio underperformed. His investors complained. For 2 years, he had to look foolish. But in the end, he was right and made $4 billion. Most people could not survive those 2 years. They would not tolerate the pressure and would close their positions, usually right before being proven correct. Patience is one of the least discussed skills in investing, but one of the most valuable. Now let's move to a very practical section. What developments will be important over the next 6 to 12 months? First, central bank decisions, interest rate policy, the Fed, the ECB, and others. As interest rates fall, valuation pressure decreases. As long as rates remain high, that pressure continues. Second, corporate debt maturities. A large number of corporate bonds will mature in 2025 and 2026. These companies will need to refinance their debt in the current high interest rate environment. This means serious pressure on profitability. Third, the dollar and global trade dynamics. Geopolitical tensions, trade restrictions, and reserve currency dynamics. These factors move slowly, but they have deep and long-lasting effects. Fourth, whether artificial intelligence investments actually deliver results. Major technology companies are investing enormous amounts into AI. The speed at which these investments turn into profits will determine whether current valuations are sustainable. Fifth, the Chinese economy. It is a critical factor for global growth. If China slows down, commodity prices, export figures, and global supply chains will be affected. Watch these developments. Follow them closely every month. Now let's put everything together. Warren Buffett is holding $150 billion in cash. This is the highest cash position in his history. Central banks have been buying record amounts of gold for 3 consecutive years. They are moving away from dollar-denominated assets. Corporate executives are telling the public that everything is great while selling their own shares. The S&P 500 is at the highest concentration level in its history. 10 stocks account for 40% of the index. Global debt is 3 times global GDP. and interest rates are high. Historically, when all of these conditions have been active at the same time, the following period has not been easy. This is not a prediction. It is a reading of the data. Maybe things continue like this for another 10 years. Maybe something happens tomorrow. Nobody knows. But being prepared is not the same as believing in a prophecy. Being prepared means becoming resilient against possible scenarios. You buy insurance. You do not expect a fire. But you still buy insurance because you do not want to burn. Remember what I told you at the beginning of this video. Smart money is moving quietly. That statement is not meant to leave you out, because none of this information is secret. It is all public. SEC filings, central bank reports, historical data. What makes the difference is how you look at the data. The difference between John Paulson and Goldman Sachs was not information. They were both looking at the same mortgage data. The difference was interpretation, and acting on that interpretation. Every generation believed that history would not repeat itself. Every generation was surprised. Maybe history does not repeat itself, but it does rhyme. And that rhyme feels very familiar right now. Now I want to invite you to think. Look at your portfolio. Calculate your real concentration risk. Evaluate your cash reserves. Create a plan for the period ahead. And make decisions based on information, not fear. Because the greatest opportunities are born inside the greatest fears. And to see those opportunities, you cannot be running in the same direction as the crowd. Do not take anything I have said in this video as financial advice. This is an analysis, a look at the cycle of money and financial history. Do your own research. Evaluate everything according to your own situation. But know this, asking these questions means asking the right questions. And if you are asking the right questions, you are on the right path.